Hello, everyone. Welcome. I'm just watching the numbers of participants click up, so we'll give it another 30 seconds for that to finish coming in. Okay, that seems to have slowed down. Well, welcome, everyone. Thank you for choosing to take some of your afternoon and spend it with us. I am delighted to be here as your webinar host and moderator. My name is Marla Orenstein, and I'm the director of the Natural Resources Center at the Canada West Foundation. And hopefully we are familiar to most of you, but in case we're not, we are a public policy think tank. We are nonpartisan, we are independent, and we are focused particularly on making things good in Western Canada and by extension, the rest of Canada. We are here today to talk about ESG in the Canadian energy sector. As you well know, it has been a really popular topic. There is so much going on these days in ESG, and there's a lot of confusion and there's a lot of hype, and we're here to cut through a little bit of all that. This webinar is coming out of a report that was written by me and by Dinara Millington and Brendan Cook, both of whom are here today. This can also be found on the Canada West Foundation's website. We put it out last August, and it's really sparked this conversation. We're going to spend a little bit of time talking through what's happening on the ground in the sector, what are some of the arguments for and against ESG, what can companies do to help themselves along. We have not opened the Q&A feature just because we actually think with everybody that we have here today, we won't have time for questions and answers. However, you're also welcome to use the chat feature to talk amongst yourselves, and if something interesting pops up there, we may choose to highlight it. So with that, I'm going to ask each of the panelists to introduce themselves, starting with Dinara Millington. And Dinara is on mute. And that's the phrase of
there we go. Thank you, Marla. Thank you. And thank you to this invitation to participate in this panel discussion. And good afternoon to all the attendees. Just a quick intro on myself. I'm an energy researcher and economist at heart. Recently, I founded my own consulting firm with a purpose to provide sound economic and economic advice on energy and environmental issues in the Canadian and international energy markets. Prior to that, I was a vice president of research for a Canadian think tank, where I managed research programs, agenda, and stakeholder relations. Thank you, Marla.
Fantastic. Thank you. Brendan, over to you. Who are you?
Yeah, so my name is Brendan Cook. I work with Marla at the Canada West Foundation and the Natural Resources Center. I'm a policy analyst here, and yeah, that's me.
Fantastic. Karen.
Hi, everyone. I'm Karen Walters. I'm Director of Sustainability and ESG Disclosure with Atco. So Atco is a provider of integrated energy, housing, transportation, and infrastructure solutions around the world. And while I joined Atco 20 years ago, I've been it's been amazing to work on this file for the last 12, and it continues to be really exciting to see the industry-wide mainstreaming and norming and forming. And we kind of joke that we were doing this before it was cool. Currently, I'm a member of the SASB, which is the Standards Advisory Group for infrastructure for the Sustainability Accounting Standards Board.
Fantastic. Thank you so much, Karen. And last but definitely not least, Susan, over to you.
Yes, thank you. I'm Susan Gray, and I'm the Director of Sustainability for Cenovus. And my team is responsible for ESG reporting, as well as the ratings and rankings and responding to those surveys and monitoring those. We also work in combination with our strategy and planning teams and members of the operations groups across the organization to ensure that ESG considerations are embedded in our business decisions and our processes. And in addition to that, also work closely with our communications teams as part of the effort to talk about ESG both internally and externally. As Karen said, with her history, I've also been with the company for a lifetime, but fairly new to this role. So joined the sustainability team in January of 2021. Prior to that was largely in finance related roles within the company.
Fantastic. Well, I really like the mix that we have here, where we're going to be able to talk about the research and the analysis and also the real world experience. So thanks for being here, guys. We're going to get started just with a very basic question, which is, we hear the term ESG a lot these days, but what is it? Brendan, can you help us figure this out? What is ESG?
Yeah, so I guess as some of our audience is probably already aware, ESG stands for environment, social, and governance. And so ESG reporting is a form of non-financial reporting that really gives companies an opportunity to disclose their performance in those three areas. Non-financial reporting isn't exactly a new topic. As we heard, people have been doing this for quite a while under different terms. We've seen corporate social responsibility, we've seen sustainability reporting, and a few others. And ESG is kind of like the newest to the party. But really between those, there is one key difference that kind of pushes ESG to a different area than those other reports, and that's the intended audience. So ESG reporting really has a close tie to the investor community, and so most of the metrics that you're going to see in an ESG report are really intended to help investors understand the risks and opportunities that a company may face based on their performance in environment, social, and governance topics.
Fantastic. And there's two terms that you've referenced here. One is ESG and ESG reporting, and the other is sustainability or sustainability reporting. Are these identical? Is ESG and sustainability reporting the same thing?
Yeah, no. So I think, the difference really is in that audience. And so in ESG, you're going to find things that are for investors to help them make their investment decisions. In a sustainability report, you're really going to find topics that are maybe applicable to more of a broader audience and cover a wider range of topics.
Right. So overlapping but distinct.
Yeah.
And one more thing to clear up about ESG, which is it's something that frustrates me a lot. I'm kind of softballing this question because I know what the answer is, which is ESG the same thing as greenhouse gas emissions? A lot of people seem to be talking about greenhouse gas, net zero. We've got ESG covered. Is that the case?
Yeah, no. So no, ESG reporting really should cover a much broader range of topics than just GHG emissions. We do see a lot of the time maybe a disproportionate focus in some ESG reports on climate change related disclosures, but really a well-balanced ESG report is going to include, of course, your social metrics, your governance metrics, and just a wider range of environmental topics, water use, land use, biodiversity impacts, and of course, GHG as well.
Fantastic. Let's get to the question about why companies are doing ESG or sustainability reporting. And particularly, Susan and Karen, this question is something I'm going to direct to you. And Karen, maybe we'll start with you. You were saying you guys were doing it long before it was a sexy thing. What were the drivers for why Atco started doing its sustainability or ESG reporting?
Sure. So I think initial drivers really investors, business partners, employees, customers, right? So sort of the same audience that Brendan just highlighted. And I think similar to what Brendan just said, this really comes down to communicating how you're managing long-term risks and opportunities. And, I would say, I feel lucky to be in a company with already a long-term balance perspective. If you think we're an infrastructure company, always this is part of what we're thinking about. We're thinking 10, 20, 30, 40 years in the future. So this is part of our thinking. But really this reporting provides an update on your strategy and how you're managing the long-term risks and opportunities, as well as your progress and your KPIs. And I guess the final point I would just make is that ultimately these are fairly complicated issues. So it is important for companies to own this narrative and tell their story. And really, if you're not publishing this info, others are doing estimates and publishing for you. So it's pretty important to get this information out, in my view.
That's a really interesting point, the one that you can choose to tell it yourself or somebody's going to be telling it on your behalf. Susan, how about for Cenovus? What were the drivers for the development of sustainability reporting there? And actually, how long has it been going on?
It's funny you asked that. I did look back in the archives because I was part of the first report. And as Brendan noted, it had a different name at that point. It was called our Corporate Social Responsibility Report. And it was in 2005. And so, if I think about what we would have published then, it would have been far more aligned with what Brendan referenced as a sustainability report, where really it was more about the narrative than it was about the metrics. And, a couple of reasons for that. Probably obviously the reporting standards have really changed over time and recently taken off. But back then it was really telling the story, disclosing what you could, looking to do better. To Karen's point, it's been something that we've been able to build over time because we did start so early in the process, and we do have that long-term lens to it. So wanting to be transparent about what we're doing, where we can do better, tracking that progress over time, doing more as you go, and just really sort of monitoring your performance and giving investors the lens to be able to see that as well. And I agree with the comment about the narrative as well, because as an oil sands company, or largely an oil sands company, some of that narrative has been taken over for us. And so we do need to get our data out there and our facts out there, our stories out there, so that people can understand what really is driving that, and where the truth lies.
Susan, you're talking here about the sophistication of the report having evolved and probably the tone of it as well. Do you think that there's been a change over time in the audiences that Cenovus has been speaking to with this report?
Well, I think it's probably the same audiences, but I think they've evolved over time as well. And if I think about, so when I was working on that first report in 2005, I was part of our investor relations team. And the questions we got then are night and day from what we get today. They really were, they still came from a lens of risk management or risk mitigation, but really they were just trying to understand if we were aware of some of these things, wanting to make sure that there was no demons lurking in the closet, or there were going to be no negative surprises. And so wanting to understand if we had a handle, but they did not get into the level of detail that we see today. And there wasn't the level of sophistication. Most investors now have their own in-house team where they might use their ESG ratings and rankings that are provided as a validation, but they're really doing their own ground-up analysis, and they have lots of great questions to ask and at a level of detail that you never would have seen back then.
That's great. Danara, in the report that I want to push to all of our audience here, we did a number of interviews with energy companies about what their experiences were and what their drivers were. Is there anything that came out for you when we were doing this report about what some of those other drivers were that Karen and Susan haven't already mentioned?
Yeah, so I think maybe I'll pick up on the last point that Susan was making about controlling your message and controlling your sort of telling your own story. I think with the rise of social media and access to information so readily available, and also potentially not understanding what's factual and what not, I think that's one of the external pressures that the business sector has identified as an external pressure for them to sort of to engage in some of the reporting and storytelling. A couple of other reasons or a couple of other elements within the.
Oh, I think she froze for a minute. Okay, well, we'll carry on and hopefully we'll get to Danara back in just a second here, which is too bad because it was going in a very interesting direction. Danara, I don't know if you can hear us, but we can't hear you right now. So Susan and Karen, when you're thinking about the reports that you're producing now, what is the benefit that you're deriving from doing this reporting now? What does it actually get you as a company for putting the work in and actually trying to get this thing out the door every year? Because it's a substantial amount of work. It's a lot of resources that go into it. Surely there's a benefit. Does one of you want to speak to that first?
I can go first. I think if I think about the progress that we've gone through this year, and 2021 is a little bit different for us given the major transaction that we had earlier this year. So we actually have two reports coming out this year. The first one we've referred to as our ESG data report, and it was published at the end of June. And it was standalone metrics for the two legacy companies for 2020, as well as some trend and variance analysis, and then some history for legacy Cenovus. The report coming later this year we'll have the pro forma metrics for the company, and those metrics will underpin the targets that we're putting out this year, and as well as our TCFD disclosure and a broader narrative. So if I think about the process we've gone through, it really is, I think it's that trend and variance analysis, and it's that performance tracking and that longer term thinking. So touching a bit on what Karen and I were talking about earlier, and being able to give line of sight to those things, to be able to, and I think internally it drives an awareness as well, and an excitement as part of the process to reset the targets. And it's a little bit of a left turn from the report, but all linked together. We did an ESG materiality assessment earlier in the year, and it was very robust, and we had lots of external feedback and internal feedback. But one of the things we did was open it up to staff to to participate if they were interested. And the response is overwhelming. We actually couldn't accommodate everybody who wanted to participate in a focus group, so they were able to do it via survey instead. But it really sort of showcased the fact that people are engaged and they want to contribute and they want to work for a company that's doing good things, that has similar values and that they can be proud of. So I think that's kind of how it, the benefit that it puts through the organization.
Are you finding, Susan, that the creation of the report itself is something that also continues to drive change within the company on how to approach sustainability issues? Or are these just two things that are sort of riding in parallel? Times are changing, values are changing, people want to see that. The ESG or sustainability reporting is part of it, but it's not actually the piece that's driving any change there.
Yeah, I don't know if it's the reporting in and of itself. It probably is a little bit of both. Mm-hmm. Because I think, as things evolve, we all get better, we get smarter, we learn to do more. I think, for myself being, not new to this process necessarily, but new to this role, it really has been a good learning opportunity for me as well to sort of dive into some of the things that are happening that I may not have seen previously, or being able to just to understand that in a deeper way.
That's great. And Karen, good, I'm off mute here. Can you tell me from your perspective, what have been some of the benefits for Atco, or what are some of the reasons that they keep coming back to doing this over and over?
Right. Yeah, I definitely would echo, some of Susan's comments in terms of obviously engagement and, an element of performance management, really, that you do have those core KPIs and you're evaluating them to demonstrate your progress. But I would say, the pure act of publishing the report is sort of not as valuable as, from my opinion, the integration into the corporate strategy, the integration into business planning, investment decisions, risk management. And I think when you look at sort of the journey of what has happened here, it takes longer to integrate. It takes longer to make sure that you're speaking the same language with people in different parts of the business. Ultimately, that is where the success is, right? In terms of shared responsibilities, those collaborations, and not silos. So, often we laugh, like it doesn't matter what you call it, right? As long as you're making sure that you're considering these types of issues in this lens. So I think that would be the additional benefit I would add to what Susan had mentioned.
That's great. Can you tell us also a little bit about some of the, and welcome back to Nara.
Thank you. I apologize.
Not a problem. This is why there's 5 of us. We can just keep on trucking. Karen, can you tell us a little bit about some of the challenges that you experience in pulling together the report?
Yeah, I mean, we used to joke too that it's complicated, ... right? But I do think in general, I think I would speak to just these disclosures really ultimately need to be as robust as financial disclosures in the future, right? And certainly the lens people are looking at with this is increasing. And so we need to, we don't think sort of the processes of all of that is necessarily keeping up with the interest in these topics. So I think that is one of the challenges, is just really getting these disclosures to the same robust level that the financial disclosures are, really, because that's ultimately where we see it going.
Do you feel that many companies are being given the amount of resources that they need to be able to actually work this out? It sounds like it's pretty time intensive, pretty labor intensive to get this all done, and not just from a small team either, but probably from a lot of different parts of the company.
I think probably the answer would be no, not enough resources for sure. But I do think, I wanted to bring to this conversation sort of the not all things to all people kind of view, because honestly, you could spend your whole year writing a 200-page report and answering questionnaires. And so I do really think that the core and the key of this is really to make sure that you're focusing on those material issues and where you can make a difference, right? So, definitely, broadly, this is change and reporting change and needs resources. But I do think that there's something to be said here about, there's been a bit of a pendulum in my view, that, 200-page reports just are not what we need here. We need to be focusing on the core issues that are material to our strategy and making sure that we're communicating those well in a black and white manner, transparently, with a view to the future, right? Because you don't want to be changing these disclosures year over year.
Yeah.
So there, but that was a bit of a charade. But you know, I definitely think we need to focus on the material issues.
That's really important. And boy, so many questions that I want to ask. Susan, I'm going to ask you, I'm going to ask you this one. A little bit about that feeling of this balance. Karen mentioned the 200-page reports. I have seen a lot of ESG reports. Brendan and I have reviewed over 200 of them for the purposes of this shiny new report. There's a lot that I'll put it this way. Many of them seem to have the strategy of having a very large narrative section with a lot of beautiful pictures and smiling people that highlight certain aspects of what a company does that they want to showcase. And then a back end that's some pretty dense metrics that goes to some of the standards, which we will talk about in a minute. But how do you get that balance right, Susan? How do you identify what's the appropriate mix to include of something that allows you to tell your unique story and yet also be comparable and address those charges of greenwashing that just says, oh, you're just showing us these nice, happy things because it makes you look good? How do you find that balance?
Well, definitely is a struggle. I mean, because you want to showcase yourself in the best light, and you get the feedback to say, you know, tell us about the things that aren't going so well. And the second you do, that comes back to bite you. And so it is trying to be transparent. I think, you know, that's the ultimate goal. And it goes back to Brendan's earlier comments about a sustainability report versus an ESG report. And so, you know, we try and do a bit of a blend to hit both audiences, and it does change over time. I mean, this year as a newly combined organization, there will be some things that we need to, or feel that we need to explain or want to explain to our audience. But some of that, once you've sort of set the table or had the table stakes, then you can kind of move on to the more direct focused things. You know, one of the things that I think is important too, we follow TCFD disclosure, and as part of that, it's about addressing the risks as well. And so, you know, there's a large section of our report that talks about risks and things that we're doing to mitigate those risks. So I think that also helps provide some of that balance. But it really is a challenge to make sure that you're trying. I mean, you can't be everything to everybody, so you need to understand your audience, and then, as Karen said, focus on what's material.
That's great. That does bring us to another big piece of this puzzle, which has to do with all those frameworks and all those raters. And we know that there is a lot of rating agencies out there, something like over 600 different frameworks knocking around. Danara, can you tell us a little bit about what are some of those major ESG frameworks, and also what's happening in the immediate future of that framework consolidation?
Great, thank you so much, Marla, and I apologize for the earlier disconnection. My usually reliable internet decided not to work today.
Murphy's Law.
Yes, absolutely. But yes, there are, like Marla said, there are a handful of internationally recognized ESG frameworks that are currently available for use for any company that they would choose to. However, it is, you know, through the research and through our interview process, it did come out that it might be quite difficult for an energy company to decide which set of standards to follow or what to reference in their ESG reporting. In some of the findings that we were able to uncover, it seems that Canadian energy companies usually use one or more of these internationally recognized frameworks to fulfill their ESG reporting. The most dominant one, the two most dominant ones seem to be the Global Reporting Initiative, which is the GRI, and the Sustainability Accounting Standards Board, SASB, as well as Susan mentioned, reporting on the climate-specific related risks and disclosures. The Task Force on Climate-Related Financial Disclosures, TCFD, is the one that is seem to be dominating currently. Within Canadian large institutional investors, there seemed to be a preference and growing endorsement of the Task Force Climate-Related Disclosures, as well as the SASB for reporting on everything else besides the climate-related reporting. Within, I guess, what's happening now, what we're seeing is this initiative, this collaborative work that is happening among all of these different international boards, standard boards, and other organizations like the World Economic Forum that are looking at unifying and standardizing the reporting measures, metrics, how to report, what's considered relevant and what's considered material for various sectors, including the energy sector. And there seemed to be a movement in that space that we could potentially be seeing some universal standards coming out sometime this year or next year.
Yeah, it's been promised for a little while, and I think everybody's waiting with bated breath to see if that's actually going to happen or not. I'm curious to know what your approach is. Again, Karen and Susan. Karen, as you said, you're a member of SASB. I would not be surprised to learn that Atco is using SASB, but is that the only standard that you're using, or are you actually managing to sneak a couple of them into the sustainability report? And how do you decide which ones?
So I feel like I'm fairly lucky in that we haven't had to be in the pendulum of doing everything for everybody. So we've been very, I think, to Susan's comments earlier, right? It's every year improving and moving forward. To answer your question specifically, we have been watching, TCFD and SASB for the last probably 6 or 7 years and moving towards them. And I think this is about core financial influences, core accounting influences. And honestly, sort of this wild west has been very time consuming for a lot of companies. So really the true leaders, I think, in this space have been pushing to have this standardization, transparency, and focus, right, on the ones that are going to be the core standards moving forward. So we do report to, under the TCFD guidance, we do, to your point earlier, report to SASB where we can, although we have to keep remembering that we have a diverse industries, and so SASB doesn't quite know how to compute that quite yet. We do report to GRI. The way we decide it really is listening to our audience and sort of trying to look through the noise to what actually is the pain point and what information do you need to calculate here that's comparable across, because we know there's a pain point for investors trying to compare disclosures across different companies. So we think TCFD and SASB and internationalization of these standards, material issues under these standards is an excellent progression, because I think it makes, as much fun as it looks like, people don't want to spend their whole year reporting.
Yeah.
You want the innovative side.
That's true. When you talk about listening to your audiences and trying to understand what are the indicators or metrics that are going to be most meaningful or relevant to them, how do you do it? How do you find those audiences? I can imagine that investor audiences might be a little more easy to reach. You have investor relations department, you know who to reach out to, but are you trying to take that a little bit more broadly to other stakeholder audiences? And how do you go about getting out from them what it is that they're concerned about?
So really, it sort of comes back to the materiality assessment that Susan mentioned earlier. And I think, we are asking many different stakeholders what is important. And, what we've found, we have sort of 5 broad material issues, is that when you do look across stakeholders, they are looking at, these are the strategic important areas that Atco can make a difference. And then once we define that, we look at what are the key performance indicators that we can be like the solid, long-term, transparent key performance indicators that will sort of communicate what we're doing in these broad areas. So I think it's a good point, Marla, like it's not just investors. You need to make sure that you're looking more broadly, again, because we're talking about managing your important risks and opportunities. Yeah. And that's not just an investor lens.
Yeah. Yeah, thank you, Karen. And Susan, do you have anything that you'd like to add about which frameworks right now Cenovus is using in its reporting and how that's come about?
Yeah, we're similar. We have the TCFD disclosure as well as SASB disclosure. And then we also follow IPICA recommendations as well, as we're a member of that organization. And so that's sort of the three big ones that drive our reporting. But it is, as you asked earlier, what are the challenges in doing this? And coming back to Karen's point about assessing what's most important and most impactful for your business, we did that through our ESG materiality assessment, and then look through what's actually possible, what can we provide, what is meaningful to our company, and how do we report on that. But in terms of a challenge, I was going to say, there are a number to figure out, a number of reporting frameworks to try and decipher. And for smaller organizations or someone who's just getting into this, I think that would be pretty daunting. We've had the luxury of starting when it was quite new and being able to evolve, and you can still do that. But to start from scratch now, when there's so much to consider and so much to learn and to filter through, I think that would be a real challenge, especially for a smaller organization that doesn't have a lot of resources to put to that.
So do you have any words of advice for that kind of small organization? Where should they start?
I think so. There's a number of organizations who are now going through comment periods. They're looking to make things hopefully more aligned, but perhaps more stringent. And I think the expectation is that those requirements would be phased in over time. But I think it really is start where you can, get your foot in the door, do what works, do what you can, and do what's meaningful, and then just continue to evolve that as you go.
Right. I'm continue to be really intrigued by this giant gulf, as I see it, or maybe it's not so much of a gulf. I'll be curious to hear your opinions between, on the one hand, these relatively well-established global frameworks like SASB and GRI and TCFD that have gone through a very thoughtful process of trying to identify what elements they might consider to be material for reporting and how that should be done. On the other hand, we have over here in this, on this side of the stage, all the ESG rating agencies, the ones that themselves have their own magic sauce of bits that they want to see and things that they look for in reports. And they don't always publish this. In fact, they usually don't publish this. And they go out and they basically evaluate your company and give you a grade. And in a what I would call quasi-ethical practice, many of them also offer to consult with your company to help you better figure out how to get a better grade the next time. And it's not nearly as clear as what you need to do there. And there are so many of them that it seems like you'd be chasing your tail forever if you're trying to satisfy all those requirements. And because they're all looking at things differently, you never can. What's your perspective? Do you just sort of ignore what's going on over here and just say, or we're just going to do the frameworks and that's the best we can? Or are you somehow keeping an eye on what's happening with all the different rating agencies and what they're looking for, because that drives investors? Susan, what do you think?
Yeah, so we have done, as part of the post-transaction, we had two different companies following two different processes. And so we went through a harmonization effectively to say, okay, what was Legacy Husky doing? What was Legacy Cenovus doing? Why? How did we score on each of those things? What makes sense for us now as this combined entity? And so we do have quite a few that we follow. Some of them, like the CDP and the Dow Jones Sustainability Index, are a really heavy lift across the organization. And so, but they do get a lot of traction. The other ones are more about a validated information. And so, we have a number that we flagged as ones that we want to actively participate in. And then others we assess as they come in terms of, what is the value to our investors? Is it something that they're using? What is the credibility of the organization? And what does it mean for us? And so, you can't be all things and you can't answer all of them. That would be, more than a full-time job to do that. And so, we do look at which ones make sense for us and which ones we can meaningfully engage in.
Fantastic. Karen, anything to add to that?
I would just say probably similar approach. There's sort of a handful that we are watching from a validation perspective, and a low-lying fruit, do they have the information right perspective? I would add, I think it is unfortunate, some of the game playing and sort of the wild west of it in terms of the ticking the box kind of stuff. It's really not helpful, I don't think. And really, I do think it's improving with SASB and material issues by industry. But really the ticking the box, sure, you can get a better score by publishing those 200 pages, but what is that actually doing? So I think, it also is a challenge of, requiring time investment from stakeholders beyond just that ticking the box. And, see the strategy, see the integration, see how they're managing the material issues. In examples like an infrastructure company like ours doing working with Indigenous partners to do northern off diesel projects, right? That can never be put into a checkbox. These are multifaceted, multiple stakeholders. And so, I would just maybe add that. Obviously, we're watching it, but you could employ 10 people all year doing this if you really wanted to. So I think it is focus. And I think moving away from the ticking the box is really, what we're hoping for in the future. And I think it's coming with the financial influences through TCFD and then SASB really saying these are the material issues.
Yeah, thank you for that. And that gets to some really interesting points that I'm going to want to circle back to. But one of the things you mentioned has to do with Indigenous engagement and relationships and how that shows up in these reports. And a number of months ago, 6, 9, who knows these days, the First Nations Major Project Coalition came out with what I thought was a really great report on the fact that the Indigenous is lacking in ESG. And it was just a good report for a lot of different reasons. But the fundamental point that they point out to me was one that is really relevant, that this incredibly important relationship does not appear under most of the standardized frameworks. And if it does, it's this big. But at the same time, it is not something that is amenable to stuffing into a little checkbox in any way, shape, or form. And so I understand that desire to say, this is something that is completely lacking from ESG. It's something that is super important. It is extremely relevant to the Canadian energy sector, that's for sure. But at the same time, I don't really see a very easy way of helping it transition into ESG. And I wonder if that's the right house for it. But we'll park that for another time. I actually want to move over to, once again, this fabulous report, and over to Brendan a bit again. Talking specifically about the Canadian energy sector, and let's talk a little bit about what we learned when we did this review. So how many companies did we look at, and what did we start to find, Brendan?
Yeah, so a lot of companies. So I think, as you mentioned, it was somewhere over 200 reports that we ended up, or companies that we ended up looking at. Not all of them had reports, but I think the big thing that we found was that reporting really isn't that consistent across the industry as a whole, considering the industry to be the Canadian energy industry. And a lot of it depends on, a lot of things, but a few key factors that we identified. And one is the size of the company, the ownership structure of the company, and the I guess subsector of the energy industry in which it operates. So for example, we looked at large oil and gas producers, and there we found that 100% of large oil and gas producers have some sort of ESG metrics available, but compared to only 20% of smaller oil and gas producers. So quite a disparity inside of that one energy sector. And then if we move outside of oil and gas, you can see that we looked at electric utilities. About 76% of the electric utilities are producing reports, about 39% of pipeline operators, and then just 33% of wind and solar operators.
So, that I found that really stunning, and especially the drop from 100% of major oil and gas companies down to 20% among the others. You said only 33% of wind and solar, not bad on utilities and on pipelines. But what do you think are driving some of these differences, Brendan, across sectors or across company sizes that we might be seeing?
Yeah, so I think, as I mentioned, comes down to size of organization, ownership of the organization, and kind of where you're operating within that sector. And I think the big thing between, as we said, 100% of large oil and gas producers and only 20% of small, that really comes down to the size of the company. And as we mentioned, there's a lot of resources that go into creating these reports, and large companies obviously are going to have those resources more readily available than a smaller company. But when we look at the difference between the wind and solar and the oil and gas, that's different. It's not necessarily the public versus private, where public companies, based again on the interest of investors, are more likely to produce an ESG report, and it's not so much based on size of company. It's likely more due to, I guess, maybe the perceived reputational risk that those industries face. So oil and gas has been under fire for decades at this point by environmentalists for potential impacts to the environment. And in a lot of ways, I think the renewables industries maybe see themselves as being exempt from that. And again, that might go back to maybe too much of a focus being placed on GHGs, where some of these companies might look at it and go, well, we don't have any emissions, so we're good. We don't need to put out a report. But of course, that's not necessarily the case. There's obviously a wide range of environmental impacts that can be reported on. There's water use, there's land use, biodiversity impacts, and no organization is really exempt from those. And then there's also the social and governance issues, which even outside of the energy industry, I mean, pretty well every company has some sort of impact in those areas.
So I know in the report, we also took a look at the extent to which those different subsectors were reporting on specific environmental topics and specific social topics and specific governance topics. What are some of the things that stuck out to you?
Yeah, so I get the big ones. So GHGs, as we mentioned, had 100% reporting across a few of the industries, that being the oil and gas industry and the electric utilities. Slightly less in the others, but still very high levels of reporting. Under the social impacts, we had health and safety, with 100% of all companies we looked at that had an ESG report had some sort of health and safety portion to that. And I think a lot of that goes beyond ESG specifically to requirements that companies just have to track that outside of the reporting requirements. But specifically within environment, one thing that struck me is once you get outside of GHG, the correlation kind of falls apart. So way fewer companies are reporting on land use and biodiversity. There's a very low percentage comparatively to GHGs reporting on waste management. That was the lowest one within the environmental portion of the reports that we found.
Fantastic, thank you. And there was a question here stuck into the chat about, do we have a number that reflects current ESG reporting for the services sector? And we do not.
No. Just
to be clear there. I found this really interesting. And once again, it's a big, thick report. So go in and enjoy that at your leisure. Let's talk a little bit about, and we have one, can we please provide the links or the PDFs? It's all one report. And I think up at the top of the chat is where it appears, but maybe Jamie can post it again for anybody who came a little bit later. It's on the Canada West Foundation website. So, our very polarized world, it's not surprising that there's a lot of polarization around the concept of whether ESG is a good thing or bad thing as well. And on the one hand, there's a lot of hype around what ESG can actually possibly deliver. And on the other hand, there's also a lot of balloon popping going on saying, no, it can't particularly deliver that. So let's take a little bit of a look at those arguments as to what extent do they hold water? To what extent is ESG an important driver of social change or environmental change or practices? To what extent it's transformational, et cetera. Then I'll start with a money question, because that's one that's raised a lot, is that, and Danara, I'm gonna target this to you, is that increasingly, more and more money is using ESG criteria as a way to identify where that money should be invested. Can you tell us a little bit about the extent to which money is being invested using ESG criteria? And is it true that you really have to be doing ESG to get investment these days?
Mm-hmm. Thank you. Sure. Maybe just to set a context, if we look at global asset portfolios, those ones that do apply ESG and sustainability criteria to investment decisions, that dollar amount has doubled over the last 4 years and more than tripled over the last 8 years. And in 2020, that number reached the value of $40.5 trillion. This is US dollars. When we look closer to home in Canada, ESG-led investments grew to just under $3.5 trillion in 2019. And that number represents 62% of professionally managed assets in Canada. If we look a little bit, if I take out some of the forecasting and crystal balling, some estimates suggest that global ESG assets that do apply ESG criteria are on track to exceed $53 trillion by 2025. And that would represent about a third of the $140 trillion projected investment under investment management. So as you can see, that's not all the dollars are applying, or not ESG criteria is not applicable to all the investment dollars that are available. While Europe accounts for about half of global ESG assets, other countries like US and some countries in Asia and to a certain extent Canada do have some strong expansion plans in that particular area. I think the next wave of growth of ESG-led investments is going to come from predominantly Asia, in particular Japan, and that's something to watch out for. But like I said, not all investments apply ESG criteria, and in our research, we identified that if it was one survey that we looked at the results of that, when the Canadian investors were asked how often do they apply ESG criteria to their investments, less than a third answered often or always. So there's still, whether that is a transition, whether that is here to stay, it's still too early to tell, I would say. But there's still some money available where capital would be available to companies that is not ESG related. Just one thing I want to sort of point on the criteria of ESG in the past, and that is changing. In the past, ESG criteria was it was appropriated on the basis of negative screening of stocks and investments, as opposed to looking at all the ESG related metrics and disclosures and placing the company within their ranking system.
That is a really interesting one. Let's go down that path for just a minute, because I've noted it come up in a couple of people's questions in the chat as well, which is this question of either divestment or exclusion of fossil fuels from some investment strategies. And Karen and Susan, I'm particularly interested in your thoughts on this, about whether good ESG performance can actually help an energy company that might fall into one of those baskets, or basically, I guess, a good ESG performance among a Canadian fossil fuel producer. Can that get you out of the problem of some entities saying we just don't want to go there? Or does it sort of not matter at all?
It should
I'm
matter.
phrasing it badly, but you kind of know where I'm going with this one.
Yeah, no, it should matter. And it's the conversation to your earlier question, often, the ESG conversation often narrows to GHG. And so I do think it is important to showcase those other areas, the 5 focus areas that we have aside from safety and governance, are GHG, climate and GHG, water stewardship, biodiversity, Indigenous reconciliation, and inclusion and diversity. And so we talk about all those things. They're all important. You can't focus on everything, but those are the ones that are most impactful for us. And we try and bring that into the conversation where we can, but it often or always steers back to GHG. And I think to your question, it's a bit of where we're a victim of our own transparency. Because we do report on all these things and we provide that disclosure, yet in a lot of jurisdictions, they're not held to the same standard, or the information is either not available or it's some kind of an estimate. And that's held against our assured, third-party assured data, where we're kind of showing our hand and being as transparent as we can be. On the divestment conversation and in the exclusionary practices, we certainly do try and engage and have that conversation. And often, we get a bit of a, oh, I didn't know that, when we start telling people about all the things that we do and some of the facts about our business. And so sometimes that works out well, and other times you're never going to change somebody's mind. And so we just continue to engage. We do find that there's a whole handful of investors that want to be part of the progress. They see the net zero ambition and they want to help us decarbonize our base business, as well as do some of these things that above and beyond that will get us there and bridge the gap to that net zero position. So there's to Daenerys' comments, there's a mix of investors, and there's people are doing it in different ways. But I think the best thing that we can do is just continue to tell that story and continue to engage with the facts of our business.
That's great. Karen, do you have any thoughts?
I guess I would just add in, being quite a diverse company, I would agree with all of the comments that Susan just made. I do think that looking only at one issue, I would completely agree with the comments that you have made. Years ago, everybody only wanted to talk about GHG, and really this is a diverse conversation. But I think, I would say even stronger when you think about the energy transition and the complex, changes that we're planning to make moving forward. I think really, getting affordable, reliable, and lower carbon systems, whether that's, renewable natural gas or hydrogen or some of the other things that we're looking at. I mean, these are the types of things that are 100% part of what we're talking about every day, part of our strategy, right? So I might be a little bit different because of the diversity of our company. We're kind of in a fairly a lot of these different places, but really solving these complex problems is not just one metric, right? Mm-hmm. You cannot build infrastructure without having considered all of these long-term issues.
That makes a lot of sense. And one thing that it makes me think about is what I've been seeing happening among stock exchanges. And a number of stock exchanges are starting to come out with guidance for listed companies and showing them what they expect or what good ESG reporting could look like. And some of them are starting to dip a toe into the water of saying, if you want to be listed, you're going to have an ESG report. I know NASDAQ did a bit of a study and had characterized different stock exchanges based on whether they did nothing or whether they recommend and provide guidance or whether they're starting to move in that direction of requiring it. They didn't, unfortunately, name which stock exchanges were which. Perhaps less so for your two companies because, again, you're already in the business of ESG reporting. But have you observed is this sort of pressure starting to change the approaches of other energy companies, particularly smaller companies or ones that are part of your supply chain that you've seen that are saying, well, all right, if I have to do this for the stock exchange, is that starting to be a real pressure?
Yeah, I'll just add in, I mean, I think it comes back full circle to, again, influences out of the financial world, the Task Force for Climate-Related Disclosures, and then the accounting world in terms of the accounting standards. And what's important here for smaller businesses that may not have the resources is clarity and black and white definitions on what's required, right? So, focus on the material issues and then have those definitions so that they can execute on it. So I do see it, obviously, like you said, stock exchanges, regulations, that sort of stuff. I mean, you could have, for the last 5 years, right, we've been watching internationally what's happening there. So, there are requirements for small companies, but I do think we have to, keep in mind that the scope and scale of this, and it needs to be clear what the requirement is, because this guessing is very difficult. I don't know, Susan, if you have more comments there, but we see it coming, but it is resources, right? So it has to be right-sized.
Yeah, no, I agree with that. I think if you think about all of the organizations that have put out requests for comment, the SEC, the CSA, TCFD, blah blah blah, they've all been doing that, and so it is a mounting pressure, and so yeah. And clarity and consistency will be important, but the questions they're asking are mandatory reporting and integrated reporting, and so I think the evolution is it's going to continue, and it will get more stringent, and it will become more aligned with the financial reporting. Is the expectation if you use those examples of where they're headed and the kinds of questions they're asking.
Now I'm on mute. One of the things that's been really interesting to me is watching that evolution of of materiality and what is considered material. I know that it was just like 2 weeks ago the GRI put out some sort of an oil and gas, or was it energy sector, Brendan? Do you remember? Is it more broad? A standard specifically for
oil and gas. Yeah.
For oil and gas. Trying to get around this problem of the fact that really very different industries are extremely different. And even the grain that it's getting to under SASB or GRI, where it's energy writ large or just certain parts of things, causes a real problem. There's an example that we have in the report of a hydro company that was saying, we score better on our ESG by installing low flush toilets for employees than we do on actually managing the water resource that is our bread and butter every day, because it just doesn't account for those kinds of things. And so watching this become more sophisticated and be able to deal a little bit better. But this is hard. This goes back to the rating agencies where, again, many times I've heard it described as, one woman alone in a room in Romania with a bunch of reports in front of her and trying for her to assess for these countries halfway across the globe, what's actually important and how well do they do on it. And it's not always easy to figure out. I know that we've only got 5 minutes left. There's 2 more things I want to talk about. One is just a quick round of what is it that you have as recommendations for companies that might be getting started on their ESG journey, or maybe even are a little bit more into it. What are some of the learnings that come from you? And then I want to cap off with a question that Richard Sawchuk very nicely led us into. Thank you, Richard. Wasn't even paid to do this, on how governments can support strong ESG performance and what they should be staying away from. So let's start with what your recommendations are, what your observations are. Susan, over to you, and then I'll hit Karen and Danara.
Yeah, and I think we talked about this one a little bit earlier in the conversation. I made a few comments, but it's about getting started. Filter through what is really important for you and what you're able to do. Start there, and because it's really overwhelming if you don't go with what you can start, what you can do and what's possible first.
So a nice bite-sized chunk. Karen, anything to add to that? What's another thing that pops into your mind?
Yeah, I think, I think echo Susan's comments, marathon, not a sprint, right? You need to make sure that you're looking forward. You've got the right North Star. You're looking forward those 2, 5, 10 years in the future, and figuring out what the core disclosures are. So just incremental your year. And once again, I know I've said it many times, but focus on what's material, which is essentially what Susan just said too.
That's great. Danara, was there anything else that came out in the report for you?
Yeah, just a couple of things that have come out through our research and interviews. One big one that stood out for me was in terms of how to start. Yes, I agree with Karen and Susan. Just start somewhere. Start looking at what's important, what's relevant, what's material. And it also from some of the experience of where companies have launched into ESG journey. One thing that came out of the interview is that there was, more often than not, there was a champion at the top, somebody in the executive decision-making role, such as a CEO or a board member, that sort of sets the tone, sets the voice for the corporation, for the company, and why it's important, what it means for the company, and it also carves out, I would say, a chunk of the budget of that company in order to get started and the resources that they might need. Another big one is decide which framework to pay attention to. Yes, it's a potentially a daunting task, especially the smaller the company, the probably the bigger of a challenge that could be, but that's definitely an important element, and watch out for that universal standardization of the frameworks. The one that we sort of touched on, we didn't really get into detail, and I'm not claiming that I know all the answers, but addressing the Indigenous reconciliation, especially for the Canadian energy sector, is so important. Many of your projects are on the communities or beside the communities where Indigenous people live and sustain their lifestyle. So it's important to engage them early and actually, see if they can offer any advice on what's important to measure and what's important to report on. There's some definitely momentum where Indigenous companies and Indigenous communities and companies are working together, but there's still gaps that remain, and I'm not going to get into it, but there's a whole list that we provide in the report where you can start there. Incorporating independent sustainability audit, I think, would be important too. The financial reporting is quite sophisticated, whereas the non-financial reporting is not quite there yet. So having that third-party verification assurance definitely makes your ESG reporting more credible. And keep it in a perspective. ESG means to an end, but not end in of itself. So that's it. I'll stop speaking.
Thanks, Sonara. We're at 3:30. I'm going to give you a 20-second overview of what governments should not do and maybe what they should do, just so we can stick that in. And again, you can go back to the report on this one. 2 places governments should not do things. Number 1, governments do not develop your own ESG standard and another set of guidelines. It's just another set of guidelines. It won't replace anything. These companies are still going to have to chase the other frameworks. It's just going to add one more into the mix. That doesn't help anybody. That's our first recommendation. Our second recommendation is that it's not useful for a government to, we believe, mandate ESG reporting by all companies in its jurisdiction or a certain subset. That pressure is happening anyhow. It's coming from elsewhere. But what they can do is governments getting their net zero ship in order adds credibility to companies' claims about their own transition. You can make it easier for companies to report. Governments hold a lot of data, and putting this together in a way that is helpful for companies and gets information out about what the bar is for companies in that jurisdiction is useful. And finally, government can take the lead on cumulative effects management, regional land use planning, and certain types of stakeholder engagement that go much beyond any one company in their jurisdiction. So with that, thank you guys very, very much for taking the time to be with us. And I realize I've been remiss in calling out here the Canadian Energy and Climate Nexus, who was the partner on this fantastic report here. And so it was not just us alone. This was very much a partnership. And if there's any ECN people out there, I'm very sorry. Thank you all. And this webinar will be up on the Canada West Foundation website in a couple of days. Thank you, everyone, and goodbye.
Thank you.
Thanks, everyone.